Welcome to the On the Edge podcast with your host, Scott Groves. Hey, ladies and gentlemen, it's Scott Groves here. I'm with a buddy of mine. Jared and I were just talking about this. We've known each other for well over a decade now, so I've seen the evolution of him, of his business, the company that he works for, Vance Wealth. And maybe we'll start there, man. Like, tell us what Vance Wealth is, how long you've been there, and like the evolution of that business. Or maybe we should start with whether or not I should buy NVIDIA stock, but we'll get to that in a few minutes. But yeah, tell us about you starting at Vance Wealth and kind of where you're at now.
Yeah, so Vance Wealth is a wealth management firm. We're based out of Santa Clarita and then have several offices around Southern California. And I started there as an intern, and my parents became clients in 2007. And I was at the time working at Starbucks and ended up starting a 401k, with $1,000 or whatever was in there when I decided to leave for an insurance internship, and met John, who's the owner of Vance Wealth, and had said, hey, I have this 401k. Can you help me with, I don't know what to do? And he was intrigued because I think any 20-year-old or 21-year-old at the time who doesn't want to take the money and pay the tax and and run, he wanted to know more. And so I ended up doing an insurance internship, and he said, I'll take you out to lunch when you're done. So give me a call. So I called him the week after. And by the end of lunch, I had an offer for a paid internship, and it was his first intern and my first experience in finance. And I've been there now 17 years.
So did you go to college for that? You knew you wanted to work in finance, or were you just going to school and this kind of like came upon just dumb luck?
Yeah. So I think I was going to school for business management. I think I knew I wanted to be a business owner or something of the like, and I didn't really know. And business management majors, they know a little about a lot, right? It's kind of casting a wide net, and I think you get experience into different genres of business or different principles. And I still didn't know, I think. And so I would ask around and friends and family, and I'd say, how did you become a lawyer? Or how did you become a mortgage specialist? And how did you always know you wanted to be a doctor? And I think I got many times people responded saying, I just fell into this profession. And so I didn't fully believe that, because right. I just kind of felt like, how do you just fall into whatever you were doing?
Like every realtor, every loan officer, every business owner ever, they kind of fell into it somehow.
Yeah. And so I didn't believe it until it happened to me, right? Until John had said, hey, you know how to speak, you know how to write, you are good with people. That's 90% of my job. And I had warned him, I don't have finance experience. I took one finance class, and I think that was my disclaimer to him. I don't have experience. And he's like, I can teach you all that. I can't teach you how to be a good communicator, how to be able to write well. And so I think that is a lot of what I do, is being able to build relationships and communicate well. And the finance is that just, you kind of learn that over time. So yeah, I think when you look at it, no, I didn't know. I didn't even know probably what a financial advisor was, to be honest, right? Until my parents had said they've hired one. I was like, okay, so they manage your money essentially. And it's so much deeper than that. But I think at the time it was very surface level in terms of what I knew.
So it's funny, because in my mind, when I think of like financial advisor, before I met you guys, and I know a lot of your clients are people that I've worked with over the years, and they've all retired well. Yeah. So you guys must be good at their job, good at your job, or at least good at keeping them on track for getting ready for retirement. But when I think of financial advisor, I have like these two pictures in my head. One is like the super nerdy Warren Buffett right-hand man reading reports and doing individual stock picks, and sometimes you win and sometimes you lose. And then on the other side is like just the flashy, obnoxious guy who drives a really expensive Porsche and, golfs at 3 different golf clubs because he's just trying to meet rich people, but like maybe doesn't actually know how to advise on the finances. And I feel like you guys fit right in the middle of like, you're just kind of like a family office for maybe somebody who doesn't have tens of millions or hundreds of millions of dollars to have a family office to run all of their finances. So what's kind of like the niche that you guys support? Like what's your target demographic for clients?
Yeah. So we have 3 main parts of our business. The first part is young savers, pre-retirees, or retirees, right? People that need a financial plan in place, whether they're young savers and have all these decisions to make on saving for kids, right? Saving for kids' colleges, wanting to know their number. How long do we have to work? Really working with those individuals. And then also on the retiree side, those are people that work so hard to build their nest egg, and then all of a sudden they are supposed to flip a switch one day in retirement, and now they have to start spending from it. right? And so they need the confidence. They need to have a plan in place to be able to feel good about spending money in retirement, because I think that's sometimes hard.
Right.
When you're saving for 40 years and then all of a sudden it's like, all right, you're retired. And it's like, wait a minute, I'm not comfortable with this. I don't know, how much can I spend? Am I able to take this money to go travel? Am I able to fly first class? Am I able to help my grandkids' education? And so part of what we do is really empower them by showing, hey, it's okay. We've run the numbers. Here's your financial plan, which is based off what's important to them, and really show them versus telling them. And I think that gives them the confidence of, I feel good about where we're at and how much I'm spending, right? And essentially try to replace their paycheck when they are working so they don't have to change their lifestyle. So that's really one core piece of our business. The other is business owners. That's definitely been the fastest growing part of our business over the last 5 years. And mostly because we became a registered investment advisor, we were able to work with business owners who had needs that they didn't necessarily have $1 million, let's say, to invest, right? To be able to pay us to give them the advice that they need. And so we're able to work with them on a consulting basis. We charge them monthly. And when you think about it, a lot of these young business owners are reinvesting into their people. They're reinvesting into their business, and they don't have the assets essentially to manage, but they need help, right? They're kind of being asked to manage a professional team that, as their business is growing, it's becoming more and more complex. And they're the ones that not only are running the business, they have family, right? Probably they have other responsibilities, but then now they're having to manage a professional team. So, a CPA and an attorney and an insurance person, right? And maybe a mortgage broker. And they're the ones that are having to facilitate everything and really be the main middleman or woman, right? And it's not a great use of their time.
Right. Right. And then is there a third category of people?
Yeah, the corporate 401k. So it happened a little bit, I wouldn't say by accident, but I think as a value add to a lot of our business owners, they're needing retirement plans, right, in place. And so we wanted to make sure we were able to not only work with the business owners, but be their advisor if needed on the corporate 401k side. So it's a very underserved area, I think, in our business is the corporate 401ks, because they're complex. There's a lot of red tape in terms of compliance. And so I think you want to work with a team that fully understands it and really is able to be a resource to the business owner first, but then also to the employee second.
At one point, I was thinking about setting up SEP IRA for my business through consolidated coaching. And it's like, well, you have to do this actuary table, and then you have to do this, and then you have to do this annual review. It's not as easy as just when you're at a company, be like, oh, cool, let me just allocate 5% of my paycheck to put into retirement. Like once you're the business owner, there's a ton of strategy. And if you get it wrong, it feels like you could really get it wrong.
Yeah. And you're having to manage that. And I think if you want to do that, then that's one thing. But a lot of our business owners don't want to do that. And so not only, I think there's usually two sides of the business owners is people that know what they need to be doing. They just don't have the time or the desire to do it, right, and help execute. And then there's the other side where they're actually not even aware of certain things that they should be doing. And so I think part of our job is to really look at the landscape and look at everything as like, what did you guys do over the last 2, 3, 4 years? And then what opportunities did you guys take advantage of and what opportunities were missed? Because then that really helps paint the picture for the future of what we may be able to help execute on.
Yeah, I love the idea that you guys created a consulting business around the biz owner, because I remember being part of Provisors, which is a big networking group, very popular in Southern California. And I remember every financial advisor was the same way. I'm looking for high net worth clients that have over a $2 million account that can invest. And it's like, okay, well, there's a lot of business owners that could get to that $2 million mark if they had the right advice, but you don't want to take them on as a client because you're not making enough of the, wrap fee or the percentage of assets under management. But they still need the advice to get there, right? Because if they can save 50 grand, 100 grand, 200 grand in taxes by being a business owner, now all of a sudden that money can become investable. But of course, you guys also have to get paid as well, right? Advice isn't free. So I like that consulting business. Can you dig a little bit deeper there? Like, let's say there is a business owner out there, they have high cash flow, maybe like good margins, but they don't have for their personal side yet saved $500,000, $1 million, $5 million or whatever. What are some of the things that you're doing with them in that biz consulting? Because that's very interesting for me. I'm being selfish here and getting some free coaching from you.
Yeah. So when you look at the type of client or the type of business owner, usually it's people that are making over 500 grand. because when you're making that amount of money, typically there's more free cash flow to allow you to start doing strategies, right, to be able to maybe reduce your tax liability. And so I think part of that is people that are charitably inclined, people that are thinking about maybe about the next generation, and also people that are thinking about the long term and not necessarily how can I save the most amount of taxes in this year. That's not our typical client, because we're looking at what are your long-term financial goals, and then really backing into, okay, well, what makes sense from a business standpoint, and being able to do these strategies with the end goal in mind, right? And so I think the types of clients, usually around 500,000 or more, and then we basically charge them a consulting fee. So depending on complexity, is usually between 1,000 and 5,000 a month, and that's a deductible expense to the business. And before, we weren't able to work with them. And so when we were we're a registered investment advisor now. I'd say 5 years ago, we weren't, and we were a little bit more limited in terms of who we could work with and how we could serve them. And prior to becoming an RA, we had to turn them away and say, hey, now's not the right time. There's certain things that we can help, but there's no way for you to pay us, right? And there's no way to work together. And so what they were able to do is build this business outside of us and probably develop different relationships and new relationships. And now all of a sudden we pick up the phone 5 years later, hey, is now a good time to reengage? Like, yeah, I'm good, right? I'm working with someone else now, and thanks, but no thanks. And so we wanted to make sure that we were that go-to person, but not in year 5, right? And really starting in the beginning, because there's a lot of decisions that have to be made early on to balance work life and home life, and think about young kids and saving for education, and making sure that we're along that path. And so not necessarily, you don't have to be a mature business, but it's a business that is able to implement strategies that require free cash flow, right? Being able to fund 401ks, right? And to be able to potentially add kids to payroll. Now they need a job, right? They need an actual job description and actually do the work, but there's certain things that we can implement that do, yes, help save taxes, but really get them closer to that long-term plan.
Yeah. I heard somebody say something at a mastermind event I was at where it's like, hey, the tax code is just an incentive structure. It's frustrating. Nobody likes paying taxes. But if you understand the tax code, it's just an incentive structure for what the government wants you to do. Mm-hmm. So you can save all this money over here in taxes if you start doing all this stuff over here, right? That's a big piece of it.
Sure.
But then there's some weird stuff that you and I have talked about, like the Augusta rule.
Yeah.
Can you explain the Augusta rule? Because to me, this is like my all-time favorite like tax loophole for business owners.
Yeah. So the Augusta rule started where it sounds like, right? Augusta, Georgia. And this was
the golf course, right?
The golf course, yes. And this happened years ago. And so basically the owners of the houses wanted to be able to rent their houses out to people that were traveling in for the golf tournament and not have to pay tax on it. So there was a tax code that was passed that basically allows individuals to rent out their house for 14 days or less and not have to pay tax on that income. And so what we've done is basically put a process in place to allow business owners to rent their home to their corporation and be able to generate rental income, but not have to pay tax on that. There's a lot that goes into that in terms of what they should be doing from a compliance standpoint. But the whole goal is to really work on the business, right? Business owners that take a day out of the month for 12 months and then should have 2 semi-annual planning days to really take a step back and take a look at the business and not work in the business, but actually do things that they're not able to get to throughout the day, right? Yeah. Just everyone knows, like, you're checking emails and you're making calls and you're in meetings, and then all of a sudden the day goes by and you don't have time to do some high brain powered activity. And so that's really part of it is, there's an agenda that will help with an agenda template. Hey, this is what a day might look like. And it starts with some mindfulness activity in the morning. Maybe it's yoga, maybe it's meditation, and really trying to set the day and then plan out what does the day look like? What are your 3 goals for the day? And allowing the business owner to really make progress on some of these bigger goals or these bigger rocks, if people are familiar with traction and EOS, and they're able to move the ball forward, because you're not able to do that in your day-to-day mundane kind of activities, right? So yeah, that's been a big thing. It's not only helping business owners save taxes, that's obviously part of it, but nice. It's been really nice to see people who are doing the work to actually improve their business and actually become more profitable and start making these strides that they maybe weren't previously doing because they didn't dedicate the time to that. So that's part of it, right? We're going to help with the agenda template. We're going to get something that's for the fair market analysis, right? We work with a site company for the studios, and they say, okay, well, if we were to rent out your home for your studio, for the studios, this is what we'd charge you, or be able to rent out your house for. And then we've looked at hotels, and it's like, how much would a day for a conference room cost? And so
$5,000 easy. Yeah.
So we help with that, basically to help pad the file, right? Yeah. And if you ever got audited by the IRS, you want to make sure it's like, well, here's the work I did. This was on my calendar. I got a calendar invite. I have a fair market analysis done. I have a rental agreement between me personally and my corporation. And so all these things, I think when you mention the Augusta rule to tax professionals, I think they aren't thrilled maybe in the beginning, but then they're used to clients just saying, yep, I did the Augusta rule, and they have no documentation.
Right.
They didn't actually spend time out of the office, and they could maybe even prove like, well, no, you were in the office or you were traveling on this day, right? Like if you get audited and they can prove that you were not where you say you were, that obviously is a red flag. So we will say, let us show you what we help clients with and help them execute. And then the CPA or the tax professional is much more like, okay, I've never seen this done before. I've only seen clients take the deduction, but not actually have the work or a process in place that you follow for 12 to 14 days out of the year.
Yeah, because this is like a tax advantage I should be taking advantage of. We have a pretty decent sized house with the podcast studio and the office and the gym and all this stuff. And we do retreats out here for our coaching clients, whereas, if it's less than 10 people, we'll just do the retreats at my house versus getting a hotel. Yep. Now we've got 10 rooms at $300 a night. Then we got to do $5,000 on a food and beverage spend at a hotel. Doing a one-day planning session with coaching clients or with your business, I mean, that can be a $15,000 a day expense, right? Yeah. So now if you guys help model that and document that and paper trail it, and then I can write that off where money flows from consolidated coaching to Scott Groves personally, and it's tax-free, like that alone would pay for your services.
Yeah. So that's, I think, when you look at the fastest growing part of our business over the last 5 years, it's been the business owner side because it's much more quantifiable, right? When you look at our retirees or pre-retirees, some of what they have to do is take a little bit of a leap, right? Because we can show them, hey, this is what we're going to do on the investment side. Here's your financial plan. This is how we can add value on the tax side of things. But we don't know exactly how everything is going to go every year, right? And so you have to revisit a financial plan every year. And a little bit of the comparison is, do you expect your CPA to know exactly how much they're going to save you how much in taxes they're going to save you every year for the next, say, 5 or 10 years? And the answer is no. You just trust them enough to look for the right things and be able to adjust with the tax code and be able to look through your taxes and say, if there's an opportunity, I'm going to help you guys take advantage of it, right? There's a little bit of faith involved in the beginning of that. So I think that's on the retiree side. When the business owners come to us, we're able to say, okay, well, here's the snapshot of the last couple of years. This is what we could have done, and this is what we plan to do going forward. Here's what we will save you in taxes just based off of you executing on these different strategies on your current tax rate. This is what it costs, and here's what we're going to charge. Yeah. And usually it's like, well, you're going to save me double or triple of what you guys might charge me. Why wouldn't I move forward? Right. Yeah. And so a lot of these business owner meetings are very efficient, and the lead time is much smaller because they want to move, right? It's like, this all sounds great. Like, let's keep going. And
if now you charge me $1,000 or $2,000 to save me $8, obviously no brainer.
And so what they want to do is offload a lot of that work because, again, they're the ones that are now being asked to manage their professional team and manage their payroll decisions. And you think about how busy people are at year end, just normal W-2 employees are busy because of the holidays and kids and engagements. If you have a business, not only are you busy there, you have employees to worry about and all these things that come up. So I think part of the business owner side is the execution, right? Helping them execute on certain things, but it's a lot easier to quantify what we might save you based off executing on these strategies.
Yeah. One of the things that I did, man, this is probably 12 years ago now, when I was thinking about like, okay, are these guys that I can refer clients to on the financial advisor side? I came in and you walked me through what a whole like initial meeting would look like with a client. Yeah. And you pulled out this big butcher paper that was all printed on it. It's like, here's where we go through, like, are you properly insured? Like, what is your interest rate on your mortgage? Like, what is your interest rate on your cars? Like, the whole financial plan And you're like, obviously there's an expectation. These people are going to bring over money that we're going to invest for them and get paid on. But when I saw that, I was like, oh yeah, these are guys that I can trust to refer people over to, because like just the totality of the picture, at one point, I don't even know if you know this, when I was at Washington Mutual doing mortgages, they wanted you to be super cross-trained so that when you sat down with a client, you could get all their products. So I had my Series 7, my Series 63, my life and annuity. Like I technically was licensed as a stockbroker. But trying to get a client to tell me everything when they're like, no, I just want to buy one $200,000 annuity. I'm like, oh, that's great. I'd love to sell you something. But like, what else is going on with you? And at the time, this is 25 years ago, I'm getting old. People didn't want to tell me that because a lot of the elder clients we were working with that had large chunks of money, they were from like the Great Depression era where you don't talk about your money. Totally. You don't tell bank A that you have money at bank B. And it was so frustrating to me. I just went full time into mortgages. Mistake. I should have stayed with financial planning because I was just frustrated that they didn't want to tell me everything and I didn't feel like I could help them. Yeah. And so at the bank, it was just like, sell more products. I'm like, yeah, but I don't even know if I'm helping these people. And when I saw your whole plan of like, no, we're really going to help these people fix all of their financial problems. Hopefully you're still doing that now that I brought that all up.
Oh yeah. Well, we have to, right? So I think we're product agnostic. So, we are not paid to sell product. As a registered investment advisor, we can't collect commissions, right? So that in itself is, we have to be a fiduciary and we have to make sure that we're acting in the best interest of our client. And the SEC basically said commission products are not in the best interest of your clients, right? So that's number one.
So wait, before we go on, can you talk a little bit more about that? Because I don't think most people understand this. Like, I happen to know from the mortgage industry what a fiduciary and an RA is, but that versus somebody that's just trying to sell you life insurance. Can you talk about the difference in the financial world of what those things are?
Yeah, so a registered investment advisor is governed by the SEC, and they have to they're a fiduciary, right, by their standards. Certified financial planners, I'm a certified financial planner. We have several certified financial planners or CFP professionals in the office. They also have to act as a fiduciary. And so we're having to act in the client's best interest when you think of a licensed financial advisor like you were, right, or a licensed stockbroker. Technically, you just have to make decisions that you believe or you feel like are going to benefit your client. They don't necessarily have to be in the best interest. And so that could mean that you could put a product in front of them that actually is going to pay you more as the advisor versus another product that might pay you a little bit less, right? And so clearly the SEC said, well, there's a lot of issues with this, and people might be buying products or being fed certain things that are not actually in their best interest, but it's a fee issue or it's going to get back to the advisor that you're going to get paid a little bit more money. Right. And so that's the big thing with registered investment advisors is we're product agnostic, right? And so if ABC mutual fund is better than XYZ, then we're going to choose ABC because that's what is in your best interest, not necessarily is going to make our pocket any heavier because you get money that gets paid back to us, right? Yeah. So on the investment management side of things, we charge an asset-based fee, that's the only way that we get paid versus, or whether we're making 10 trades in an account every year or 100. Right. And so there you've heard of maybe churning accounts where that is like the old stockbroker model, right?
Buy this, sell this, buy this, I'll get paid for each trade.
Yes, exactly. And so in that model, there's obviously potential for, mismanagement of money and being able to call and say, okay, I want to place this trade and maybe it's not in your best interest, but it's creating more commissions for the advisor.
Yeah. I remember when I was at Washington Mutual, the guy that I was learning from, seasoned vet, amazing financial advisor, the account executive that loved him the most was from Franklin Templeton, I think, because they had a great bond fund and something else. And he sold a ton of that to older people that just wanted capital preservation. And then all of a sudden they came out, and I think if Washington Mutual wouldn't have gone under because they bought a bunch of toxic mortgages, they would have gone under with a lawsuit over a Washington Mutual group of funds. Because at one point they're like, well, we'll be like the American funds. We'll start our own, desk and our own hedge fund managers. And they were paying more to the financial advisors if they sold the Washington Mutual Fund, which did not have a long track record, did not outperform anything else. But it's like the broker got more sitting in the bank if they sold this fund over this fund. Performance be damned, and whether or not it was the best thing for the client. And I'll never forget my buddy Jason being like, dude, I'm not going to switch till they have like a 10-year track record of beating the market, because I don't know. And he's like, and all of his contemporaries were just slinging those funds because they were making, 1% more, whatever the case may be. And I was like, this is really dirty. Like of all the things the government regulates, this is not one of them. And sure enough, they weren't fiduciaries. So there was no responsibility for them to sell the clients like the cheaper fund that had the longer track record, which just completely blew my mind. And I think that's when I first was introduced to the word fiduciary.
Yeah. Well, and it's kind of, when you think about what they're focusing on, they're focusing only on the investments, right? And so you think about what we do, we have to look at everything. And I think sometimes people will joke when they say you're a financial advisor, right? It's like at a cocktail party. Well, what, like you said in the beginning, should I be buying NVIDIA? Or I have 100,000. What stock's hot out there? What should I be buying? And it's like, I have no idea, one, who you are, and two, what this money is going to be used for and what the time horizon in is, your risk tolerance. And so there's all these things that go into making those decisions for those clients that really don't start on the investment side. It starts really goals-based financial planning, right? And talking about what's important to you, what's going to be important to you over the next couple of years. Are your kids going to college? Do you need a budget for that, right? And what about what's important for you long-term? Do you want to retire in a different state? Are you going to buy another house? Are you wanting to save for your grandkids' education, right? All these short-term and long-term goals that really impact the way that you invest your money. And so I think that's when you, and then also the tax side of things, right? So if we don't fully understand the financial plan and the financial side of things, and then the tax side of things, when you look at tax code now and your income now, well, what if income's going to be much less next year? Well, maybe we delay some income. Maybe we don't do charitable giving in the last 2 weeks of December. We actually wait till, if your income's going to be higher next year, we push it to next year so you get the deduction. Right. And so if we don't fully understand the financial side of things and the tax side of things, we can't properly invest your money. And so it's a little bit more like a doctor malpractice where they come in and ask you a question and say, all right, here's your medication. Well, you got to go through the steps, doc, right? You got to go through and you got to hit on my knee and you got to, take my blood pressure and go through all your process to fully understand what is wrong or what does this person need to be put on a path to recovery, let's say.
Because it's a much different tactical decision by you. If I'm like, hey, I have $100,000, what's hot? If I get $10 million in assets and I'm like, this is my $100,000 lotto ticket, cool, do whatever you want. If this is $100,000 that I have to get dividends off of to retire without having to eat top ramen every night, much different decision. And how do you guys build that trust with people to get them to totally open the kimono and be like, yeah, here's where I'm in debt. Here's what I owe on my mortgage. Here's where I've made some good financial decisions. Here's where I made some bad financial decisions. Like, how do you build that trust? Because I imagine you get referred to somebody, like that referral's probably strong. Yeah. But then what's your process for building that trust? Because to me, that was always the hardest part, working in the bank where there's other, bankers and tellers around. Nobody wants to bare their soul at a desk in a bank and be like, oh, well, I actually got divorced and here's where I got screwed up on my credit and whatnot. Like that's hard to do.
Yeah. Yeah. I mean, so we'll take a prospective client through what we call our client experience, which is a series of 2 meetings, and we're interviewing them just as much as they're interviewing us. Right. Right. And so we have a series of 2 meetings that we don't charge for. And we really want to try to ask those questions. If the prospective client is doing all the talking in the first meeting, that's a good meeting, right? If we're doing all the talking, that means that we're probably not the best fit for each other, and we're talking about how we can help, and we don't actually even know who the client is or what's important to them. So we'll go through a series of meetings. Really, the first meeting is all about them, ask the right questions. And then usually at the very end is a financial advisor good for you, right? Right. Are you ready to go down this path of, we're certified financial planners. We need to understand your estate side of things. We need to understand the tax side of things. We want to see your tax return, right? And a lot of information is on your tax return. And so if you're not ready to give that up, you're not actually allowing us to be able to identify spots that we believe we can add value. So if they're very hesitant in that process of the first 2 meetings, we say, you know what, I don't think we're the right fit because we can't fully diagnose or properly assess where you're at and where you want to be. And it's going to make it much harder for us to be able to serve you properly. Yeah. So I think they have to be ready to kind of go down that path. And like you said, open up the kimono, be able to release their tax return. We work with family and friends and people in the community, and a lot of referrals that are their friends, right? And so I think they sometimes might be worried about, well, I don't want my information getting out there. And so we know that because of that, we have everyone's information. We obviously we make it a point to make sure that security is top priority, and then also not sharing, right? And if someone wants to say they're a client of Vance Wealth, great, but you're not going to get that from us because that's a client, right? We don't want to give that information out. And a lot of them, obviously, will talk about they work with Vance Wealth and here go see our financial advisor. And so clearly they will say that. But I think it was one client that had been sent to me and they ended up hiring us. And there was the referral source. She didn't end up knowing, like, oh, well, I didn't know she ended up hiring you. It's like, well, yeah, because I didn't say that.
You never know,
And so she was shocked, like, oh, I guess Jared was right. He doesn't actually say that unless I get explicit information or permission to say, I want to tell the referral source that you're moving forward. Is that okay? And obviously they usually will bless that.
It's very funny because I also have the same thing on mortgage, right? We're seeing everybody's credit score and tax returns and assets and all the deep, dark secrets. Yeah. And like, I know 3 people who I've done loans for who all have investments with you that don't know that the other one of their friends are invested with you, which is exactly how I think it should be, right? Because that can get weird breaking down that level of trust. I wanted to go back real quick about the corporate 401ks, right? Like, what's the benefit? Because in my mind, anytime I think of like benefits, I think of like, okay, well, here's another cost to the business owners. What are some reasons that a business owner might want to start a 401k for, whether they have 2 employees, 20 employees, 200 employees? Like, why would somebody want to take that on as a business expense?
It's a good question. In California, you're required to now, right? So that's number one. There's a compliance piece of that. The second is employee retention, right? Being able to have a good benefits package. I think you know how hard it is to get good people, right? And if you're lucky enough to get good people to walk through your door to work for you, it's hard to keep them because there are other great businesses out there that are trying to get good people. And so they're all competing for the same talent. And so I think you want to make yourself competitive and make sure that there's a retirement plan in place or a benefits package in place that is to benefit your employees, right? I think what happens so much is the corporate 401k side is a little forgotten about, right? And it's this deep black hole that doesn't get a lot of love because, again, it's expensive and it's hard to understand if you don't have the right, professionals in place that are helping you through that. So what happens is you get something in place in the beginning, maybe when you have a couple employees. Well, what happens if you continue to grow and you're at 5 or 10 or 20 or 50? That same 401k or that same retirement plan that you had in place when you were a really small company, things change. And so I think you need to make sure that you're going back and having things looked at and looking at the fee, right? And having a comparison done of this is what we were paying. Well, you likely haven't changed in terms of the fee structure and your investments that you have access to. You likely haven't changed over a couple of years or 5-year period, however long it's been. So the benchmarking study is very important to basically say, hey, if we were to go take this to other companies, what would they charge? And what would my investment options be then? And what does the advisor make, right? And so there's all these different like a fee process, a benchmark study that you would go through to make sure like, okay, no, we're good with our current plan or not. And there needs to be some changes. So that's one thing. I mean, the business owner does not want to be talking to employees about, hey, this is how you should set up your retirement plan. And they're maybe not the expert, nor do they want to dedicate time to that. You want to have an advisor in place that is able to be a resource for not only the business owner for their personal financial plan, but also the employees who might have questions of, I've never done this before. This is my first retirement plan. What does a deferral even mean? What do you mean you're going to take my paycheck? How does that work? Is that pre-tax or is that post-tax?
Right.
Do I do a Roth 401k or do I do a traditional? And so, half of our job is education, right? When you're thinking about, you don't know what you don't know. And so we're not there to tell clients they're doing it wrong or doing it bad. Is really just to open them up. This is what you could be doing and really empowering them to make more informed decisions going forward. It's their money at the end of the day, right? And so all we can do is just paint the picture of this is what you can do. And then they say like, well, based off the education and what I've learned, this is what I'm going to do. And I feel really good about it because now I fully understand it. Yeah. They don't necessarily want to have to come up with that themselves, but they like to be informed, right? They like to kind of know what's happening and then make good decisions and feel really good about it, and not just make them in a vacuum. So I guess getting back to another comment you had made, we're not replacing people on the professional team. So you had asked, how do you get people to open the kimono? And basically tell you everything, their deep dark secrets of debt and credit cards and spending, right? We sometimes will get bank statements and it shows certain things on there. And it's like, we're not there to judge. We're really there to help, but we need all the information. And so we will not replace your tax professional, but we want to work and collaborate with those people. So working with like mortgage professionals or tax professionals or your estate planner, and really not having to go through the client to get whatever we're trying to get information on or the strategy. Well, you know how telephone works, right? And when you were a kid, whatever it got to the last person, and it was never right. It was never what was said in the very beginning. And so we're literally asking our clients, if you're doing it that way, to translate things that maybe they don't fully understand and getting to the professional. So we just say, well, let's just schedule a meeting with them. We'll just have a call with your CPA. And so you can be on the call and we'll just go through what we think, right? What we think makes sense, but we need your tax professional because they're the ones that sign the tax return at the end of the year or in April. We need them to buy off, right? We need them to say, yep, I'm on board with this. But sometimes they come back, the really good ones, and say, hey, you're not thinking about this, or this is something that changed, and what about this, right? And so the ones that collaborate, those are the ones that are the best, because the client gets to see, oh, these guys are working together in real time, and they're figuring out what makes the most sense for my benefit. And I think that's really what we make sure in the beginning is your team collaborative, right? Will they return emails from a financial advisor? Or we've had people unfortunately say, I don't send your tax return directly to financial advisors. And they say, I'm asking you. And they're like, nope, we'll send it to you and you can forward it on. So those, I think, are red
those
flags.
are the fun ones to work with.
Yeah, those are the red flags. Clients say like, man, this is making a lot more work for me. And so sometimes they'll realize, you know what, maybe we need to find another professional, whatever it is, because they don't play nice or they're not collaborating with my other team, my other professional team.
One of the things that I really liked about when we first met years ago is I was talking about like, okay, well, I was referred to by somebody that was getting ready for retirement. And I'm like, what do you do in retirement as far as like asset allocation or, you know, and I had all these questions based on my previous training at Washington Mutual around like, oh, well, how, does everything just go into safe money? And you're like, dude, these days, if you retire at 60, 65, like there is a life expectancy of another 20 or something years. You probably have to have some more growth. And I don't remember exactly what the numbers were, but you're like, we parse out this much for living expenses. You know, it's not invested at all. And then we have this much in safe and we have this much. Like, how are you guys thinking about that in this market where I don't know whether we should buy NVIDIA or not, but it does seem like a lot of stuff is pretty top heavy, right? Yeah. Whether that's PE ratios or individual stocks are really like pushing the S&P 500. How are you guys thinking about like asset allocations for those clients that are approaching retirement or retired? Like what kind of plan do you give them?
Yeah, it's something that's been developed over the last, decade plus. I think when I joined John, we didn't have as good of a process in place to determine what is the right asset allocation. And we've learned through different ups and downs in the markets that we want to focus on what we can control. Right. And it's not which way the markets go or what NVIDIA does as a stock. Right. So what we decided was we're going to focus on cash flow, and really, especially for retirees, people that are relying on their portfolio for spending, is what are you going to need to spend out of your accounts over the next 7 years? And the reason we use 7 years is because it took about 6.5 years after the Great Recession in 2008, 2009. It took about 6.5 years to get back to even, right? The peak that was set in October of 2007. So we say, okay, well, do we think we're on the verge of another collapse like that? No, we don't. But if we went through another extended weak market, we want to make sure we're going to sell from fixed income or cash investments to be able to weather the storm and allow your growth assets to recover. And so we basically, like you said, the first 1 or 2 years, that should be really invested in T-bills or cash alternatives or money market, something that's very, very safe, right? Because when you need that money, you want it to be there.
Right.
And then from years 3 to 7, essentially is going to be more fixed income, more conservative assets. Obviously, fixed income can lose money, and so it's not risk-free, but we want to make sure that it's low volatility or low risk. And then anything years 8 and beyond should be invested for growth. Right, it should be invested in U.S. companies and in international companies. You might have more speculative stocks in there or cryptocurrencies, right? And so things that have a little bit more speculation, obviously more risk, more return, but you need a longer time horizon because we're really confident that the market's going to be higher in 10 years. In the next 10 months, I have no idea.
Right.
And same
Such
thing,
a good way to think about it.
Yeah, and the same thing with the housing market, right? And I think is now a good time to buy? Well, it's always a good time to buy when you have time on your side, right?
Yep.
If you're thinking about flipping a home, I'm sure you were asked this many times.
Every day.
Hey, Scott, should I buy this house? Well, tell me, are you going to live, the forever home, right?
Right.
Or is this is a 10-month flip and it's like, well, there's a lot more risk with that.
Right.
I don't know if this is a good time to buy because you only have 10 months.
Yeah.
That makes timing very, very difficult in the beginning to figure that out because you can't time the market. We figured that out. So that's why we do focus on getting access to really good companies that are going to continue to innovate. There's a lot to be excited about. I think that's on the horizon in terms of AI and jobs that don't exist yet that are going to exist, right? And new ways of thinking. And you have these great business leaders and businesses that are moving us forward. It's like, I want to experience that growth. But I also know that market's been hot 3 years out of the, 2023, 24, 25, all great markets. And so historically, markets are negative 1 out of every 4 years. So volatility is a normal part of investing. I think that's also part of the education piece is you will lose money, right? In the first 2 meetings, we talk to prospective clients. Your accounts will go down. And so your accounts are $1 million now. A 14% correction is on average normal volatility. That's a loss of 140 grand, right? If you have $1 million. Well, what happens when you double your money in 7 years and now you're 2 million? And then what about another 7 years or 10 years? You're now at 4 million. And so as you continue to grow and consolidate your accounts under one roof, we warn clients like the dollar amounts are going to start getting very uncomfortable or very large, but it is normal. So you're never going to feel good about losing money,
right?
But you can understand that, all right, well, this is just on paper, right? If I'm not selling my growth assets at down 10, down 20, down 30, I'm not locking in that loss. If I can sell from a bond or sell from cash, I'm going to allow everything else to recover. And so I'm not actually locking in that loss on my longer term money.
Yeah. I love everything you said there, especially that 10 months versus 10 years. Cause if somebody was like, should I buy an investment property in Vegas? I'm like, probably not in the next 6 months. I don't know, because there is a lot of volatility. There's a lot of stuff going on kind of at the meta level that we don't know. But in 10 years, I have no doubt there's going to be more Californians moving here. They're going to eventually open a movie studio here, although that just got declined. So it's like, if you have 10 years to be in any house anywhere. I bought a house in Los Angeles July or August of 2007, literally the worst time in history to buy a house in a market that had seen rapid growth. I think within a year, it was worth 50% less. Mm-hmm. And 5 years later, I sold it for double what I bought it for. Yeah. And then I wish I would have held it because now the house is worth over $1 million and I should have held everything.
Yeah.
But if you have that long-term time horizon, and I also like what you said there about pre-framing with them, because that's got to bring in significantly fewer phone calls when the market does adjust, that you're pre-framing it with them of like, hey, losses are part of investing. Totally. What happens if a client doesn't understand that? Do you try to re-educate them? Do you fire them? Like, what if it's not a good match?
Yeah, I mean, it's certainly happened. In terms of, and I think it's less about the client not being a good match and us not doing our due diligence on the front end to make sure that we're a good fit for each other. And so we're continuing to improve and get better and try to identify, why didn't this work out? Is this something that it was out of our control, or could we have done better communicating our investment process, right? And when the market does lose money, what we do or don't do. Right? We don't go to cash. We don't time the market. And so we want to make sure that before they hire us, they understand that we're not going to sell when the market's down 10%, right? It's like, we will sometimes get those calls. Hey, remind me, the market's down 10%. Are we doing anything? And it's like, we plan for this, right? Especially if you're in retirement, we're selling from assets that are holding up much better than your stocks. And so we're going to sell from those assets, get you your money, and allow everything else to recover. So part of that is reviewing the financial plan again, right? Going through education and saying, this is why we don't do what maybe you're asking us to do. Because history has shown the average investor who tends to act with emotion has significantly underperformed the market.
Oh, yeah.
Significantly. And so we just will have those resources because we have access to the best and the brightest in the industry, right? When things are happening, they know that advisors need data, they need one-pagers, they need case studies, they need graphs, they need things to be able to share those with their clients because they're going to be getting the questions. Right. Now, we get less because we try to do that on the front end and say, we know this is going to happen. This is a normal part of investing, but you still get people that it's a hard time, right? Yeah. When markets are going down, it is a tough time to be able to just say, Vance Wealth said, stay the course. Vance Wealth said, just don't put the news on. Vance Wealth said, this is normal. It's like, well, tell me that on the phone again, right? Yeah. They just need to just be walked off the ledge. Like, let's come on back and we're going to be okay. And here's why. Sometimes they're newer clients that maybe haven't gone through as many downturns and maybe are used to people being a little bit more active in the accounts. And so that doesn't mean we're not making investment changes when it makes sense, but because the market's down, it's not going to spur something in us to say, well, let's sell in the account, unless it's tax loss harvesting, which is obviously a benefit for selling an investment at a loss to book that loss. You
to save on taxes.
To save, yeah. It's the example of if you own Coke as a stock, right? I'm not recommending Coke, but if you own Coke as a stock and Coke's down 10%, well, I want to take the loss on Coke, but I want to own access to the beverage industry that Coke was in. So I'm going to buy Pepsi for 31 days, and I'm going to basically book the loss on Coke, go into Pepsi. So just in case that industry comes back in those 31 days, you get exposure. You're not just sitting in cash. And then after 31 days, well, Coke is the desired investment, so I'm going to go back into Coke. So you can do that at a fund level. You can do that in an individual stock level, but that's the only thing that we're proactively doing in a down market is trying to make lemonade out of lemons, right? Because people are going to sell stocks in the future at a gain. They're going to sell their home or another investment property or business, and so they might have capital gains. Well, if you're building this tax loss carry forward, you can take $3,000 offset ordinary income, and then you carry forward the rest. So if you're doing this in an active down market, now you can offset your capital gain when you sell your business for X million dollars and you have capital gains tax. Well, my advisors were building up this tax asset for me. Now maybe I've accumulated $100,000 of tax loss carry forward that's going to save me $50,000 in taxes if you're at the highest tax rate.
I have to explain this to the layperson that might be watching this, because when I truly grasp this, it just like it short circuited my brain. So if you're watching this and you don't know what tax loss harvest is, if you buy Apple and Apple 10Xs and you make $5 million on Apple, you have to pay capital gains on all of that money. If you buy $5 million of Apple stock and it goes to zero, you get to write off $3,000 a year of that, which is just, it kind of makes me understand why people cheat in the stock market and do insider trading. It's like, well, if I lose, I can write off $3,000. And if I win, I have an unlimited tax liability. So it's like, you can carry those losses forward till some point in the future. I was actually watching if that happens. I was watching a case study where some guy had years and years and years and years of harvested tax losses, and then sold his business for several $1 million and owed nothing because he had lost on other investments and they had been doing the strategy that you're talking about. So how many people do you have on the team managing this stuff, right? Because I know your firm has grown exponentially and you're a partner now, and John's been around for a long time, but like the team has to have gotten much bigger than I remember.
Yeah. So when I started, we were a team of 3 plus John, and now we're a team of, I believe, 20 plus John. And so we 3 others became partners this year, which was really exciting. I mean, I've been with Vance Wealth for 17 years, and so it was nice to have that come to fruition, because it took a while to have that conversation. John agreed, like, yep, this is something I want to do for him personally, right? And then it just took a long time for that to come to fruition. So yeah, in terms of the team in place, I mean, our investment team is pretty slim. Anthony Goring is our investment manager. He is a rock star, and he does a lot on his own. We have some interns that have helped in the past. We had maybe an investment associate that's been able to help as well. We're trying to actually rehire for that role. But we're pretty efficient in terms of being able to look for those things. And a lot of it comes down to what we were talking about earlier, is process, right? Having process in place. And so when John created the business back in 2003, he made sure that he did it all himself. Right. And so he documented how to open an investment account and how to transfer money, because what he wanted to do was say, great, now that that's documented, I'm going to offload this task or this job responsibility to someone else that I can pay X amount, but I can go free up my time and focus on higher revenue generating activities. Yeah. So the whole firm was built off process, right? And so now we have really great processes in place and double checks and triple checks to make sure, like, is there a tax loss harvesting opportunity on the books? Well, let's look at the process, and someone other than Anthony now can run that and be able to double check and say, hey, I flagged something for you. Now you need to go look at it, right? So other people are able to help on the team to bring it to someone who can make a decision and say, yep, go ahead and go forward. But if that wasn't documented, think about all the time and the man hours that are required to just coach someone verbally through that. And then to remember all that, right? So you spend the time to do that. Well, if it's not documented, I'm going to have the same questions the next day, Scott. If you tell me something, I'm going to come back to you and say, hey, you walked through that, but I remembered it in the moment. I did it in the moment. We executed fine, but tomorrow I totally forgot, right? The next day you forget. So that's been one thing that we've been very diligent about, is making sure that process is documented, that we can also coach the younger advisors through. If someone comes in the door, this is the process you're going to go through. These are the questions to ask. Here's how we prepare a summary for prospective clients. This is what you should be going through, because that's going to continue to keep happening, right? And so you don't want to have to do it over and over and over. It's like, I want a really good place to start, and then you customize it based off what makes sense.
You mean you run your business like a business?
We try to, yeah. And so EOS changed our business, and that's something that we've done maybe 8 years ago, and we've had the fastest growth since that year, right? 2017 probably. Have grown the fastest, and our team has grown. We've doubled our team in just the last couple of years, just because we've had to. And I think we're also, quote unquote, overstaffed when you look at our revenue and our households, but we're also staffed to grow. And we know that we're a team of 20 now. I mean, our 10-year plan is to be over 60 people and managing, I think, $10 billion. And so we're close to $1 billion now. And so you think about the growth that's required. It's like, you need people. You need really good people in place. So
great
that's
people,
exciting.
good systems, good results.
Exactly. Yeah.
And I want to close with this question. What's something going on in the financial planning business, or just the market in general, that maybe people aren't talking about, or that they should know about, either with your particular office and business, or just in the social zeitgeist? Anything going on out there that people should know about?
I think what's happening, this came up because the partnership conversation this year, and John and us as a partner group, we really wanted to make the decision that we're going to sell in-house, right? John sold in-house to 3 other partners, and going forward is we're going to have a plan in place to be able to sell internally, right? And so not only to advisors, but potentially to other staff, to be basically an employee-owned firm. And I think when you start comparing that to what's happening in the industry, private equity is coming in and scooping up a lot of companies like ours, and they're paying these multiples that we can't compete with. Right. And so what's happening is it's actually really taking away from the customer experience, because private equity and what they're interested in, right? And so what happens
interested in buying 500 advisors, rolling them all up to one company name, and then reselling it, and they want out in 5 years. So they don't really care about the customer experience. They just want assets under management, repackage it, sell it, and be done with it, right?
Correct. Yeah, and it's all about the bottom line to them. And so what happens is the customer experience is sacrificed. And I think the clients that are at a firm that private equity comes in, some of them sometimes can feel like, you know what, I feel a change, right? I feel a change because they sold to private equity because it was a multiple that the owners could not say no to. But then the transition for the clients is just not a great experience. And so that's something that I feel like we're really proud to say, nope, this is something that we're going to commit to, and we know that we're going to be selling internally over the next, say, 20 or 30 years. I mean, John's 50, I think 51, he just turned. So his plan is to be in the business for at least another 15, 20 years. And by that time, we should have, maybe it was probably 30% of the employees might have some ownership.
Nice.
And so that was something that was really important to us, to say, let's make sure that the goal is to not build up the firm to sell to private equity, is actually to give these people this career path for them and be able to feel like I'm a partner of something bigger than myself. And I think that was one thing that I had to convince my wife of when we met, is she said, okay, so when are you going to break off and like do this on your own? Because she had some other friends that were advisors. And I think when we met, she had thought that I was going to be with John or Vance Wealth for a certain amount of time, and then I was going to break off and do my own thing. And I think the more she got to talk to John and the more she realized what we were building, she's like, oh, okay, I get it now. You guys are going to be building something way better together than you're going to be able to do on your own. And so it took some time, but it's like, I've been there for 17 years. You just don't see that, I think, in a lot of places, because they try to say, well, I'm going to go recreate the wheel. It's like, well, if what you're doing is what you think is one of the best that you've seen in the industry. Why wouldn't you want to just be a part of that with that person and grow something together versus try to do this and then maybe regret the grass isn't greener on the other side? It was right there in front of me the entire time.
Yeah, there's a mortgage company that I'm familiar with. I won't say their name, but the owners sold the company as an ESOP to their employees. And not only was that great for retention and all this other stuff, it's like to see a processor or maybe a dock drawer who's probably never going to make $50,000 or $60,000 a year in their life, to see them have a couple $100,000 account balance in their ESOP,
pretty cool.
Knowing that that's there for them when they retire because they're an owner in the business. It's awesome, man. It's a way to reward great employees
and keep them.
Yeah, and you keep them. And I love what you're doing versus like, okay, let's just grow to a certain number and then sell to private equity and then go start the next thing. It's like, oh man, I understand that model. I think private equity serves its place in the business ecosystem, but it just really grosses me out at my core because I like going to Wright Auto Body and my auto body guy who I trust and I know he's going to do a great job. I don't want to go to like Mako and just fill out this form, do this, we'll get you your car whenever we can get it for you. It's like, what happened to the personal experience? And that's on replacing a rear view mirror or a side mirror, much less like managing my entire financial portfolio, my wellness, my retirement wellness.
Yeah, that's the thing is it's still a people business, right? When you think about AI and you think about the robo-advisors, when that became a thing like 5 years ago, I think there was a lot of talk in the industry. Are you worried, right? Are you worried that your job's going to go away? It's like a robo-advisor can't do what we do, right? Because a lot of it is just the relationship and being able to get real-time information and then take that and kind of, build a plan or adjust the income tax projection or go through something in real time. You can do robo investment, right? I would be worried if I was a stockbroker or just an investment management. Yeah, I'd be worried because you can just plug in certain things in a formula on a robo advisor platform and they spit out, well, based off that, here's your allocation. Well, if that's all you're doing, then yeah, I would be worried. But I think when you look at how we serve our clients, we are a big team, but we also know that we're a relationship business and you want to make sure that you don't work with a client for a couple of years and then pass them to the next advisor and then they work with them and then pass them to the next advisor. Cause then all of a sudden they're like, I hired you because of Jared or I hired you because of John. And now I'm working with someone that I have no idea who this is. I have no relationship. And you think about sticky relationships, it's not sticky by the time it gets through 3, 4, 5, 6 advisors. So we really want to make sure that we try to protect those relationships that are in place because it's hard to get new clients. And if you can get a new client, you want to make sure you keep those new clients. And obviously part of what we try to do is work with the next generation. So whether it's a business owner or retiree, we want to make sure we're involving the next generation because those assets are going to transfer eventually. And we have a firm that's going to exist beyond John, beyond myself, right? This Vance Wealth is probably going to exist beyond all of the partners certainly that are in place. And so we want to make sure that those assets stay in Vance Wealth and it might work or it might require us to work with the next generation at a reduced cost or for free or have a family meeting and say, what's important to client and does your kid know about that? Getting back to, the generation of you didn't share any information. Well, that's changing, right? That is changing now. And so those people, unfortunately, they're dying off. I guess, I don't know how else to say it, but they're dying off and their kids are saying, God, that was so hard to settle mom and dad's estate. I had no idea what I was walking into. They didn't involve us in anything. And I don't want to put my kids through that. And so they're involving their kids. Now, our clients are involving their kids much sooner because of the fiasco and the headaches that their parents put them through because they're of the generation that they'll get what they get. And I'm not going to share anything. I could have $1 million. I could have a penny to my name, but they won't have an idea. And so that is shifting. We are seeing that. And it's exciting because it allows us to do more planning proactively, which I think is hard for some individuals to do. But the generation of not sharing information is becoming more, few and far between.
Awesome, man. What's the easiest way for people to get in touch with you?
They can call me at the office, which is the 888-775-0950, or email me at jared.ferguson@vancewealth.com.
You're going to have to spell that because there's 9 ways to spell Jared.
Jared is JERROD.Ferguson, FERGUSON @vancewealth.com.
Perfect. We'll put all that stuff in the show notes. And hey, man, thanks for coming in. I appreciate it.
Thanks, Scott.
Awesome.